What up, Investor Nation? Ryan and Bryan from iFund Cities. We're here today to give you a quick market update and talk about one of the things that's probably one of the most boring things in the finance industry, but one of the most fundamental or core foundational things that are important to investors when they're benchmarking investment decisions. And so that is the yield curve. So with that, I'm going to kick it over to Bryan. He's our managing partner. He's our capital markets expert. So Bryan, what is the yield curve?
Well, first off, nice shirt. The yield curve. The yield curve is the best way to think of it is it's the risk-free rate, the market's expectations around treasury rates. And so it's largely broken into different duration buckets. 2-year, 5-year, 10-year are kind of the most common things that people mention. And so you have duration on the bottom of the chart, if you think about it in a forward-sloping curve, and then the yields. What are the absolute yields for those duration buckets?
Makes complete sense. So I guess building on that, if you're an investor looking at the yield curve, what are you trying to glean or interpret? What's that telling you?
Good question. So when you're making a buying decision, you're typically comparing against one or two different products. When you're making an investment decision, it's giving you the same kind of benchmark of what you would want to, what you could invest in. So you could invest in, theoretically, a risk-free treasury, 2-year, 5-year, 10-year asset, or you can go into a different asset class that would have you would try and model or benchmark against a similar duration bucket, but hopefully a higher yield for that duration.
That makes complete sense. So a lot of changes recently on the yield curve, right? Inverted yield curve. Now we're normalizing or steepening. What does that mean for the economic outlook of the United States? And also, what does that mean from second part, two-part question? What's that mean for potential institutional investors?
All right, good. So where we've come, the last year has been, a lot exciting, especially if you're in the real estate market. And so you've seen the 2-year part of the yield curve drop, say 160-ish basis points, where the 10-year, the longer end, has only dropped 80 basis points. And so as a result of that, you've seen a steepening. Inversion of the yield curve typically means a concern about future economic activity, possibly even a recession. A steeper yield curve represents the opposite of that, more confidence around where the economy is headed by higher interest rates in the future. And so from an institutional capital, where they are constantly needing to evaluate where they're going to place the next dollar of their investment book, is you should see more dollars from institutional capital flow into assets outside of treasuries, as now they're more confident about where the economy is headed, or more confident than where they were maybe a year ago.
It makes complete sense. So what that means for real estate investors is potential more liquidity into the RTL space or DSCR space, non-QM. So your rental loans, your fix and flip, your bridge loans, could be alternative capital coming in because they see a brighter outlook, right? They can't sit on their hands from a duration perspective and invest in treasuries at 5%. They're lower yielding. They have to match their assets and liabilities on their books and portfolios. So that could be an interesting opportunity for investors to access new capital. And as we see the contraction of rates, we may see maybe more bank receivership, M&A.
It's possible. I mean, we're projecting more banks, that are going to that might be merging together as rates we've steepened a little bit. Rates are a little bit lower on the front end, and so we could definitely see some consolidation there with banks. And so this is a great institutional capital is going to probably fill a lot of that void.
Yeah, I think as your investor day, you probably what we've noticed as operators is as banks consolidate, the institutional bucket hasn't filled what the local, regional, and super regional banks have largely been financing for real estate investors. And so we're hopeful as rates come in, we see a normalization of the curve or steepening of the curve, that potentially brings more dollars to you guys, and hopefully we can fund your next deals. So look forward. We're going to be back on, I think, November 9th for a much larger market update with Bryan and Jack. Tune in.
Post-election. See ya.